The next wealth boom might happen. It might be huge. It might make headlines. It might turn some investors into millionaires and still not save you. Because the problem isn't just missing out on a 100% gain. The problem is being trapped by a single source of income in a system where prices move before your paycheck, assets move before your bank account, and crises arrive before most people understand what's happening. Many people don't fall behind because they're lazy. They don't fall behind because they're stupid. They don't fall behind because they didn't try. On the contrary, they work harder, save more, cut expenses, postpone plans, accept pressure, work overtime, manage their anxiety. And even then they feel that life is getting heavier. If you want to understand economics without panic, without magical promises, and without the complicated language of Wall Street, subscribe to the channel, because the idea here isn't to sell certainty. It's to translate the system before it runs over you. The uncomfortable truth is this: a salary seems like security, but it's often just a short rope. It arrives once a month, while rent, insurance, interest, taxes, gas, tuition, medicine, and debts are constantly adjusting. And when a new cycle begins, those who depend solely on their salary usually realize it too late. First, prices rise, then, assets skyrocket. Then, interest rates change. Next, credit tightens. Then, companies cut costs. And only at the end does the average worker look at their own account and think, how could I have worked so hard and become less secure? This video isn't about chasing the next trendy asset. It's not about guessing the next central bank meeting. It's not about buying gold, Bitcoin, real estate, or stocks because someone shouted that now is the time. It comes down to a tougher question. If the next wealth cycle starts tomorrow, are you positioned to participate in it, or are you just waiting for your next paycheck to survive? You build your routine on top of it, and, because of this, the brain begins to confuse predictability with security. The predictability is not the same thing as protection. A person can receive the same salary every month and still feel more vulnerable, because the number that appears on the deposit slip may be the same, but the world around that number has changed. Rent has gone up. Groceries have gone up. Insurance has gone up. Car payments have gone up. Credit cards have become more expensive. Idle money buys less. And the person looks at their own life thinking, I haven't changed anything, so why does it seem like I'm losing? That's where normalcy bias comes in. The brain looks at yesterday and assumes tomorrow will be similar. If the job has paid the bills so far, it seems secure. If the idle money hasn't disappeared from the account, it seems protected. If the crisis hasn't yet arrived at your door, it seems distant. Then comes recency bias. If the market has recently fallen, the person thinks investing is too risky. If the market has recently risen, they think they've already missed their chance. If gold has skyrocketed, it seems obvious they should have bought it sooner. If Bitcoin has fallen, it seems obvious they should never have looked at it. The brain transforms the latest market movement into permanent truth. And in the midst of all this comes paralysis. The person opens a video about stocks, then another about gold, then another about real estate, then another about recession, then another about crypto, then another saying cash is king, then another saying cash is trash. In the end, they don't feel educated. They feel frozen. So do what seems safest. Do nothing. But doing nothing is also a decision. Leaving all your money idle is also a gamble. Relying on a single source of income is also a risk. Ignoring inflation is also exposure. Salary can be a foundation. But when it becomes the only foundation, it ceases to be a base and starts to become a cage. The Fed doesn't press a magic button that puts money in the average family's account. It doesn't wake up in the morning thinking about how to make you pay less at the supermarket. Nor is it a movie villain controlling every penny of your life. Its role is to manipulate the price of money. And when the price of money changes, almost everything around it changes along with it. When interest rates rise, money becomes more expensive. Companies think twice before taking out loans. Families think twice before buying a house, a car, or financing anything. Credit cards become more burdensome. Old debts start to hurt more. Speculative assets, which depend on cheap money and optimism, tend to suffer. Projects that seemed brilliant with low interest rates start to seem dangerous with high interest rates. In this environment, those who are in debt feel the pinch. Those who depend on credit feel the pinch. Those who live paycheck to paycheck and have no margin for error feel the pinch before they can even understand the technical explanation. But when interest rates fall, the game changes again. Money becomes cheaper, companies can obtain financing more easily. Investors begin to seek higher returns, money circulates more, stocks may rise. Real estate may appreciate, growth assets may gain strength, cryptocurrency and speculative investments may once again attract attention. The sentiment in the market shifts from fear to appetite, but this also comes at a cost. When cheap money enters the system too quickly, asset prices can rise before real life improves. Those who already owned assets see their wealth grow. Those who are waiting to save money to buy those assets realize they have become more expensive. And those who depend solely on a salary continue trying to reach a moving target. That's why so many people feel like they're always too late. It's too late to buy a house, it's too late to invest. It's too late to protect your money, it's too late to understand inflation. It's too late to realize that the crisis doesn't affect everyone in the same way. The Fed doesn't directly save ordinary families, it changes the rules of the game. And the system usually rewards those who understand these conditions first. Those who have liquidity, those who have assets, those who have margin, and those who can act without being overwhelmed by panic. A person who lives solely on a salary is not condemned, but they are at risk. Because if interest rates rise, she may suffer from debt, job losses, and expensive credit. If interest rates fall, she may see assets rise faster than her income, and if she doesn't understand either scenario, she becomes a passenger in a car that someone else is driving. The point is not to perfectly predict every decision the Fed makes. The point is to understand that when the price of money changes, your personal risk also changes. Not because you need to know exactly which one will happen, but because you need to stop living as if there's only one possible path. First scenario, the Fed cuts interest rates. On the surface, this sounds good. Loans may become cheaper, businesses can breathe easier. The market may like it, stocks may rise. Real estate may gain strength, risk assets may attract money again. People start to feel that the party is back, but there's a detail that many people ignore. If interest rates fall, while the cost of living remains high, you may see assets rising without feeling any real relief in your life. The stock market may rise while your groceries remain expensive. The housing market may react, making it even more difficult to buy a house. Credit may improve, while simultaneously pushing many people into new debt. In this scenario, those who already own assets may benefit first. Those who only have a salary may see prices rise ahead again. Second scenario, the Fed keeps interest rates high for longer. This is the scenario of prolonged hardship. Nothing explodes all at once, nothing seems dramatic on the first day. But the pressure continues, credit cards remain expensive. Financing remains difficult, companies hold back on hiring. Families cut back on consumption, small businesses suffer, the market becomes selective. Opportunities exist, but they require more patience, more cash flow, more discipline, and less fantasy. This is the scenario in which many people go bankrupt not because of one big wrong decision, but because they lack the margin for error. A medical emergency, a job loss, an unexpected retirement. A debt that seemed manageable, rent that goes up. One bad month that turns into 3 bad months. When interest rates remain high for too long, the system begins to separate those who have financial stability from those who live on the edge. Third scenario, the Fed raises interest rates again. This is the scenario the market hates to hear. Money becomes even more expensive. Credit tightens further, indebted companies suffer. Speculative assets may fall, real estate may freeze. Families with variable debts feel the impact. The fear of recession increases, optimism disappears quickly. But even in this scenario, there is a type of person who gains strength. Those who have cash, those who have little debt, those who are not desperate, those who can wait, those who do not need to sell assets at the worst possible time, those who have not turned every penny of their life into a gamble. Do you see the pattern? The problem isn't just what the Fed is going to do. The problem is what happens to you if the Fed does the opposite of what you expected. If you bet everything on an increase and then a decrease occurs, what happens? If you're completely invested in cash and your assets skyrocket, what happens? If you took on debt thinking that interest rates would fall and they remain high, what happens? If you've become paralyzed waiting for certainty, and that certainty never arrives, what happens? The wrong question is, what is the Fed going to do? The right question is, what happens to me if I'm wrong? Because the average investor doesn't usually go bankrupt because they can perfectly predict the future. They go bankrupt because they build a financial life that only works in a single scenario. It only works if the job continues. It only works if interest rates fall. It only works if the market goes up. It only works if inflation slows down. It only works if nothing unexpected happens. But a financial life that only works when everything goes right is not a strategy. It's an addiction disguised as normality. Another says real estate is a safe haven. Another says real estate is going to collapse. Another says stocks are too expensive. Another says staying out of the market is the biggest mistake. And after consuming all of that, you no longer feel prepared. You feel more tired. Because too much information, when it doesn't come with structure, doesn't lead to clarity. It becomes noise, and the worst part is that this noise stirs up real pain. The pain of feeling like there's a game going on and you're always late to the party. The pain of seeing politicians, banks, funds, insiders, and big investors seem to position themselves before everyone else, while you're trying to decide whether to pay the credit card bill, increase your savings, buy an ETF, hold on to your money, buy gold, or take a little risk with crypto. And that's where the frustration comes in. People try trading because they're tired of falling behind. They study for hours. They change their strategy. They buy on breakouts. They sell out of fear. They hold when they should cut. They cut when they should wait. And the account keeps bleeding. Meanwhile, on the internet, everyone seems to be winning. Everyone bought in early. Everyone correctly predicted the bottom. Everyone knew it would go up. Everyone shows profits, but almost no one shows the emotionally devastated journey to get there. Then people start to wonder, is investing really possible for ordinary people, or is it just another machine that takes money from those desperate to change their lives? That's a tough question, but it's an honest one. Because when you live solely on a paycheck, every financial decision feels like a matter of survival. You're not just choosing an investment, you're trying to protect years of work. You're trying not to make mistakes with the little you've managed to save. You're trying not to be the last to understand a system that seems to change the rules while you're still reading the manual. And that's why this video isn't here to sell certainty. It's not here to say that a single asset will save you. It's not here to shout that now is the time. It's not here to pretend that there's a simple answer to a complex system. This video is here to help you survive the uncertainty. Because the truth is that the next cycle can have huge winners. But it can also destroy those who enter it without understanding the risk involved. It can enrich those with structure and crush those who are merely reacting to fear. It can reward patience and punish despair. It can make some people seem like geniuses, when in reality they were just less vulnerable at the right time. So before asking which asset will go up, ask something else. Am I making decisions with clarity or with fear? Am I building protection or trying to make up for lost time on a bet? Am I investing because I understand the role of that asset or because I'm ashamed of having missed the previous cycle? That's the difference between participating in a cycle and being used by it. How many months, really, with money available, bills paid, and food on the table, without depending on credit cards, loans, or someone else's help? This question reveals more about your risk than any prediction about interest rates. The second question is, how much of my income depends on a single company, a single boss, a single contract, a single source? Because when everything depends on just one place, you have no income. You have only temporary permission to breathe. The third question is, how much of my money is silently losing purchasing power? Money sitting idle may seem safe because the number doesn't fall. But if prices rise and your money buys less, it has fallen in a way that your bank app doesn't show. The fourth question is, how much worse will my debt get if interest rates remain high? Credit cards, financing, personal loans, variable debt, long-term installments. Sometimes people think the problem is not finding the right investment, when the real issue is debt growing faster than any likely return. And now comes the question that hurts the most. Do I own assets, or do I only have accounts? Because many people work for years and, in the end, have a collection of bills, subscriptions, installments, rent, interest, and obligations. The money comes in and already belongs to other people. If you feel you're working more but becoming less financially secure, comment with the word salary. And if this explanation is helping you see the system more clearly, leave a like. Now, the last question on the map is the most important. Am I investing, gambling, or reacting emotionally? Investing requires a plan, gambling requires hope. Reacting emotionally requires haste. When you buy something just because everyone is talking about it, that's not strategy. When you sell just because you panicked, that's not protection. When you change everything with every new video, that's not financial education. It's anxiety using investment language. The goal isn't to become a macroeconomics expert, the goal is to stop being fragile. Because a vulnerable person needs everything to go right, they need their job to keep its bounds. They need the market to go up. They need interest rates to fall. They need inflation to slow down. They need no emergencies to occur. A less fragile person can still suffer, can still make mistakes, can still face crises. But they have leeway, they have cash, they have less destructive debt. They have skills, they have some kind of asset. They have patience, they have enough clarity not to turn every headline into a desperate decision. And perhaps that is the biggest difference between those who survive the cycle and those who are swallowed by it. It's not about knowing exactly what will happen. It's about knowing how much your life can withstand if you're wrong. Because trying to predict everything turns you into a hostage of every headline. But following simple signs makes you less blind within the system. The first sign is inflation. It's not just the official number that appears in the newspaper, but the inflation that appears in your life. Has the market become more expensive? Has insurance gone up? Has rent increased? Has the energy bill changed? Has eating out become a luxury? When inflation remains a constant presence in family budgets, even if the market wants to celebrate, there is hidden tension. The second sign is employment. As long as people remain employed, much financial pain goes unchecked. But when layoffs, hiring freezes, and cuts in technology, retail, banking, construction, or small businesses begin, the story changes. Salaries seem secure until the day the company decides to protect its own balance sheet. The third sign is default. If more people start falling behind on credit card payments, car loans, rent, or mortgages, it shows that the pressure has moved from theory to reality in families' kitchens. This is the kind of data that reveals what nice speeches try to hide. The fourth sign is housing. Look at mortgage rates, house prices, rent, and affordability. If houses remain expensive, interest rates remain high, and wages don't keep up, the market may appear strong on the outside but broken on the inside. A property doesn't need to fall 50% to become unattainable. It just needs to rise faster than your income. The fifth signal is the interest rates on government bonds. This may sound technical, but think of it this way. If the government has to pay more to borrow money, the whole system feels it. Businesses feel it. Banks feel it. Lenders feel it. Consumers feel it. The cost of money spreads like an electric current throughout the economy. The sixth signal is the language of the Fed. Don't just listen to whether they cut, raise, or keep interest rates the same. Listen to the words. Are they worried about inflation? About jobs? About credit? About a slowdown? About confidence? Often, change begins in the language before it appears in the decision. The seventh sign is company profits. If companies are still selling, still making profits, and still hiring, the market is breathing. But if they start cutting costs, reducing projections, laying off workers, and talking about weak consumers, it shows that the real economy is losing momentum. And the final sign is consumer stress. When families use credit cards to buy food, withdraw savings to pay bills, delay payments, and stop spending on small things, it shows that the problem is no longer distant. It has become part of daily behavior. You don't need to become an economist, but you need to stop being the last person to realize that the ground has shifted. The goal is simple: to observe inflation, employment, credit, housing, interest rates, Fed language, profits, and consumer stress. Not to panic, not to sell everything, not to buy anything on impulse, but to adjust your life before the pressure turns into an emergency. Because those who wait for total clarity usually receive it too late. There could be a new wave of liquidity. There could be a moment when stocks, real estate, gold, Bitcoin, or some other market surges while most people are still trying to understand what happened. But cycles don't save unprepared people. A cycle of wealth doesn't automatically pay off your debts. It doesn't create your emergency fund. It doesn't eliminate your bad financial habits. It doesn't teach you emotional control in the midst of panic. It doesn't transform a desperate gamble into a strategy. It doesn't change the fact that if everything in your life depends on a single paycheck, you're vulnerable even before any crisis begins. And that is perhaps the hardest truth to accept. The problem isn't just earning little. The problem is having no margin, no assets, no liquidity, no skills to increase your earning power, no clarity about risk, no protection when the system changes direction. Because when the economy changes, it doesn't ask if you worked hard. She doesn't ask if you were tired. She doesn't ask if you did everything right. She doesn't ask if you saved as much as you could. She doesn't ask if you deserved a better chance. She just changes. Interest rates change. Prices change. Credit changes. The job market changes. Assets change. Confidence changes. And those who were building some form of protection have options. Those who were living on the edge are under pressure. Therefore, the goal is not to get rich tomorrow. The goal is to stop being fragile. It's about building a life where being laid off doesn't destroy everything in 30 days. Where a rise in interest rates doesn't turn every bill into a nightmare. Where inflation doesn't silently erode all your hard work. Where you don't have to chase after every promise of profit because you're desperate to recover lost years. You don't need to perfectly predict the next cycle, but you need to stop depending on just one thing, one salary, one employer, one strategy, one hope, one source of security. Because the next cycle can create wealth, yes, but it can also reveal who was merely surviving under the guise of stability. The next big bull run won't save those who lack structure. The next crash won't spare those without margin. The next crisis won't wait for you to feel ready. So look at your financial life honestly. How long can you go without a salary? How much of your income depends on a single source? How much of your money is sitting idle, losing purchasing power? How much worse will your debt get if interest rates remain high? Do you have assets or just bills? Are you investing with a plan or reacting out of fear? These questions are uncomfortable. But comfort is precisely what leaves many people unprepared. The next wealth cycle won't ask if you worked hard. It will ask if you were positioned. Comment salary if you want the next explanation. Leave a like if this video helped you see the system more clearly. And watch the video that's appearing on the screen now, because it shows the next piece to understanding this crisis and starting to build a less fragile financial life.